Hi, folks. Can you hear me? Good. I was, before I started, a little bit of a nag. I was checking the Google Master Sheet and looking to see if you've entered your company. And there's still a lot of empty spaces. So if you've not entered your company yet in that Google Master Sheet, please do so because I'd like that sheet to be complete by the middle of this week. So on Wednesday, or after this class, actually by tomorrow, I'm going to actually send out emails to people whose names have no companies next to them. And that's just a reminder that you need to get the company nailed down as soon as you can. Any questions before we start, though? No. So we'll give it maybe 30 seconds more, see more people joining in still. Okay, folks, it's time for launch. So we're going to start, as always, with our start of the class test. And I'm going to pose the question, then I'm going to pick on one of you to answer the question. And, don't worry about getting it wrong, because we'll reason our way collectively to an answer. Okay? So today we're going to talk about taking the equity risk premiums we computed by country. If you remember last session, we came up with equity risk premiums for other parts of the world by building off a US premium. We're going to take that and run with it. But we're also going to introduce a different way of estimating equity risk premiums. And those of you from my corporate finance class probably remember this approach, where we replaced historical premiums, backward-looking premiums, with a forward-looking premium, an implied premium. So I'm going to lay the foundations for both of those in today's start of the class test. So let's start with a very simple question. Okay? Let's suppose you're valuing an Israeli software company. It's headquartered, traded in Israel, derives 95% of its revenues from the US and 5% in Israel. You remember, Waze was an Israeli startup, right? It ended up being bought by Google. So a lot of software companies in Tel Aviv. So this is one of those companies. You're trying to compute an overall cost of equity for the company. Which of the equity risk premiums are you going to use? And I'll give you the choices. You can use the Israeli equity risk premium, you can the US equity risk premium, or you can use a weighted average of the two. Mark Tyson, I'm going to put you on the spot. Israeli company, headquartered and traded in Israel, but gets 95% of its revenues in the US, 5% from Israel. What equity risk premium should I use?
I would choose the third option, weighted average.
Weighted average, right? You know what the default in most appraisal places is, including many banks? The equity risk premium used is the country in which the companies. I've never understood the logic for it, right? It's a weighted average. Let me push back though. Let's assume that all of the let's assume the regulatory framework in Israel is very different than the regulatory framework in US, and since they're an Israel-based company, they're covered by that regulatory framework. Or the bulk of the people who are writing the software are based in Tel Aviv. They're Israeli software engineers. Should that be somewhere in the mix? I mean, because when you say weighted average, I'm assuming you're using the revenues, but all of the stuff they do to create the business comes from the software engineers and the regulatory framework. Would that change your answer?
I guess I'd just respond by saying that, to the extent that like the regulatory and tax laws in Israel influences, the bottom line with the company, it's really like, friends, if it's 95% in Israel, 5% in Israel, then, really just weight that by 5%, and then you're accounting for it.
So you're saying the revenue weights will work for that as well. What about the fact that their employees are all in Tel Aviv? That's an issue, right? I mean, you could get all your revenues outside, but if your production is in a country and the country goes to hell in a handbasket, their operations are going to be affected. I know I've sold you on this revenue weight thing perhaps too well in the corporate finance class, but I'm going to kind of provide the foundations for when that might not work, right? Revenue weights are fine, but then you start thinking about operations, and maybe I have to weight operations in. In fact, I'll go give a second example, and John LaBelle, you're going to be my guinea pig for this. You're valuing a Nigerian oil company that gets all of its oil from Nigeria. It's headquartered and traded in Lagos, but all the oil comes from Nigeria. But it sells most of the oil outside Nigeria, 95% in the US, 5% in Nigeria. When I ask you what equity risk premium you're going to use for this company, Mark, in the previous example, used the revenue weights to come up with this. Would your answer be the same, or might it be different because it's an oil company?
It's not so much that it's an oil company that would make it different for me. It'd be more so the fact that it's getting all of its inventory from Nigeria.
But how is that any different from all your software engineers being in Tel Aviv?
Because the software doesn't necessarily come from Israel. You can relocate that to anywhere. It's almost like when you're looking.
So now you're saying if I get into trouble, I can put my software engineers on a gigantic Boeing 747, fly them to the nearest safe spot, and continue to produce software, but I can't take my oil reserves out of Nigeria and put them in Switzerland, which might be a much safer location for them. It's
Exactly.
Actually a classic problem with natural resource companies. You cannot flee from your problems, right? So when I look at natural resource companies, and we're going to look at a couple of examples, I'm going to use where you get your oil as my basis for equity risk premiums, not where you sell your oil. You sell into a global oil market. I've now opened the door saying some companies I use revenues and some companies I use production or operations. Let's complete the picture. Let's suppose you have an Indian automobile company. Its manufacturing plants are all in India. It gets 95% of its revenues in the US, 5% in India. Already you can see here you care about both sides, right? Because unlike the oil company, you can't say, well, you don't care where you get your revenues. If you're selling the bulk of your cars in Europe, that clearly factors in. But you also care about the fact that your manufacturing plants are in India, which, you can't put clearly software engineers are more mobile than oil reserves. But manufacturing plants are somewhere in the middle, right? You could move them, but it's a lot more work building a new factory in another country than moving your software engineers. So you know what the solution could be? Why do you have to pick one? Why not put half your weight on where your production happens and where your revenues occur? I'm saying think flexibly. There is no one rule that's going to apply across companies. And if you look at your company, if you already picked a company, think about where it produces its goods and where it sells them. Both might enter into my equity risk premium computation. So ready? Let's kind of put this into practice. Close it. I think we were on page 64 of your packet, in case you're wondering where we're. I'm sorry, 54 of your packet, if you can get there. And let's build on this theme. So I left you with that country risk premium page. Before I start using those equity risk premiums, are there any questions about how I computed those equity risk premiums and how they come into play? No. So I'll go show you the page, just in case you've completely forgotten over the week we've been apart. No. So I'm sorry, I have to start on page 1. When I do the reading view, it doesn't seem to want to go to the page I wanted to go on. So the page I left you with was this page. I'm sorry. Come back. Remember all the clicks I made. Sorry about that. So on page 53, you saw the country equity risk premiums by country. Now it's out of control. It's now on page 76, but no. I'll wait for it to catch up. So on page 53, if you turn to your slides, you had the equity risk premiums by country. This is not where I want to be. Okay, let me try this again. Sorry about that. So any questions though about equity risk premiums by country? So let's review how I computed those equity risk premiums by country. I started with the US premium. I looked up the default spread for the country based on the rating or the CDS. Then I scaled that default spread for the additional risk of equities to come up with an equity risk premium by country. So, okay, so yeah, it took me a while to get there, but that's the page I left you on. Okay? The one thing that I didn't get a chance to talk about is if you look at the top right-hand corner of this page, okay, you'll actually see some countries listed: North Korea, Congo. These are countries called frontier markets, markets where you don't get a rating. And I didn't quite fully explain how I got those risk premiums. I used this political risk service course to kind of measure how much of an equity risk premium I demand for those countries. So at this point, I have my equity risk premium for every country. You're saying, how am I going to use it? Well, with the company, I've got to make a choice of how these country equity risk premiums play out in my company valuation. The first approach, which is the one that most bankers use, is that every company in a country is equally exposed to country risk. So if you're an Indian company, every Indian company is equally exposed to Indian country risk. And to add that country risk premium onto every company. So it's a constant. In the second approach, what you do is you bring that country risk premium into the brackets and you multiply by beta. Implicitly, you're assuming that high beta stocks are more exposed to country risk than low beta stocks. It's the approach I'm going to use for most companies. But there's a third approach that I'm also going to describe, where you assume that a company's exposure to country risk can be very different from its exposure to all other market risk. Remember, betas measure exposure to all other market risk. You can assume that the exposure to country risk is very different from all that other exposure, and measure how exposed you are with a measure that I'm going to call a lambda. I've concocted this measure. Notice the word I use, concocted. That doesn't suggest deep thought. I'll give you the history of this measure. But basically, lambda looks just like a beta. If a lambda is 1, you're as exposed as the average company in that market. If your lambda is greater than 1, you're more exposed, and if your lambda is less than 1, you're less exposed. We'll talk about how to think about lambdas. But in every one of these, I'm trying to bring country risk into the picture. And here are my choices. I can do what most bankers do, what most appraisers do, which is if I know where you're traded, I give you the equity risk premium, whichever country you're traded in. So if I look at Royal Dutch, depending on which listing I look at, UK or the Netherlands, I give you an equity risk premium for that market. But as we saw even with the start of the class test, that makes no sense. If you're an Israeli company that gets 95% of your revenues in the US, why should I treat you like every other Israeli company? And that's where the operation-based equity risk premium comes in. Now, the easiest way to get an operation-based equity risk premium is to use revenue weights. So here I've given you 2 examples, right? If you look at the first one, which is Embraer in 2004, Embraer is a Brazilian aerospace company. But in 2004, when I was valuing it, it got 97% of its revenues in the US and Western Europe. It got 3% of its revenues in Brazil. From a pure revenue weight perspective, its equity risk premium looks like the equity risk premium for a US company, even though it's a Brazilian company. You take Ambev, which is at that time was primarily a Brazil-based beverage company getting its revenues across Latin America. I'd use the same principle. You ask me, what equity risk premium would I use for Ambev? I'm using the revenue weights based on where they sell their beer, and I take a weighted average based on revenues. There are 2 advantages of using revenues. One is it's easy to get. For most companies, this is the only metric that is often broken down geographically. fact, you go into any manufacturing company, try to figure out where their factories are. It's like pulling teeth. Most companies don't even report it, but revenues are broken down by country. You know, the second big advantage of revenue weights is revenues are always positive. Thank God for that. If I used EBITDA weights or EBIT weights, one of the problems I'm going to run into is what if you get negative EBITDA from a country? Well, how do I weight it? So for maybe 75, 80% of the companies I value, the weights I use tend to be revenue weights. I'll give you the exception though. And this is not just emerging market companies. If you gave me Coca-Cola and said, what's the equity risk premium for Coca-Cola? Even though it might be Atlanta-based and a US company, its revenues come from all over the world. I'm going to take a weighted average. The one thing you notice that's different here is notice that the parts of the world are broken down by region. They don't actually tell you where in Europe. They just say Western Europe, Eastern Europe. And it's not my choice. This is how Coca-Cola broke their revenues down. You got to live in the world you're in. When you look at your company and you look at revenue breakdowns, and I'm trying to preempt some of the questions you're going to send me, is I'm looking at my company, I'm looking at the revenue breakdown. They seem to give these very broad parts of the world. One of the things that drives me crazy with European companies is often they will take the Middle East, Africa, and Europe and put it all as one group. Why? What possessed you to do this? How do I give you an equity risk premium? But it is what it is. And that's why if you look at the picture of equity risk premiums by company, by country, with each part of the world, at the bottom, you'll actually see an average for that part of the world. So if you take Eastern Europe and Russia, there is an average that's a weighted average of the equity risk premiums of every country in that region weighted by GDP. And the reason I provide that is for companies like Coca-Cola, where the only thing they give you is a regional breakdown, you need a regional average. So for most companies, revenue weights work. But if you gave me, just revenues and I use those weights, there are two issues. One is by focusing just on revenues, I am not factoring in all of the other risks you're exposed to. Your production might be in a country, or your regulations might be different. And I'm also not bringing in the fact that some companies are more exposed than others, and beta measures that exposure. So I'm going to fill in those gaps. With Royal Dutch, for instance, I'm not even going to look at revenues. To get the equity risk premium for Royal Dutch, and this was in 2015, I looked at the production based on where in the world it came from. And oil companies are pretty good about it. They'll tell you where their oil reserves are and where their production is. I looked at their oil and gas production by parts of the world it came from and took a weighted average. So rather than revenues, I'm focusing on production. And my rationale there is, for an oil company, that's my risk. My risk comes from where you get your oil, not from where you sell it. And Royal Dutch is an unfortunate problem, which is oil is in the riskiest parts of the world. It's almost like God curses you with oil. Have some oil, now take the rest of the risk that comes with it. And because Royal Dutch is an oil company, it's exposed to all of this risk. So when I compute the equity risk premium for Royal Dutch, it looks like the equity risk premium for an emerging market company. And when I did this, I actually did the valuation of Royal Dutch in 2016 in London. People were surprised, but they said it's a British company. I said, only in name. If your oil comes from the riskiest parts of the world, guess what? You are an emerging market, a very risky company, and my equity risk premium has to reflect that. So can you use production? Absolutely. Can you use revenues? Absolutely. Can you use both? I don't see why not. Depends on your company. If you're a consumer product company, I'm just going to focus on revenues. If you're a natural resource company, I'm going to focus just on production. If you're a manufacturing company, I might end up somewhere in the middle, because I think both where you get your revenues and where you produce those goods play out in your equity risk premium. So any questions about how these equity risk premiums, so for your company, and I'm going to make this specific to your project, what do you need to do? You need to go find out where your company gets its revenues. You can find that. You can find the annual report. You can find it in a 10K if you're a US company. You can even get from S&P Capital IQ, which is pretty good about breaking these things down. That's the first step. And you can use revenue weights, but when you do that, stop and ask the question, should I be looking at production as well? Maybe you will change your mind. And if you decide to also bring in production and operations, then you might need to dig a little deeper, see where their production is. And you might not be able to find, in which case it's not your fault. It's not like somebody's holding, they just don't reveal that information. But I'm saying be flexible. Think of ways of bringing in operating risk. Any questions on estimating equity risk premium for a company? I'll tell you one of the things
I have
that's
a
really
quick
going to.
question.
Yeah, go
if
ahead.
you don't mind.
Greg?
So what about an example where you have a services company, let's say consulting, that gets all of its revenues from US-based companies, but some of their clients, if they have business and operations outside the US, do you have any sort of trickle down ERP, or do you take that into account?
I see your point. I mean, you're a US-based company, you consult with oil companies. In a sense, you are indirectly exposed to the risk that those companies face. I don't know how far down this ladder you want to go, because ultimately what you're pointing out is we're all exposed to global risk, no matter how concentrated a company might be. And that, so I think you have a point, but I don't want to get too far down that line because I don't know where to stop. But you have a good point about consulting firms. Consulting firms live in reflected glory and reflected play, right? So if you ask me, what's a beta for a Deloitte or a KPMG or any large service-oriented firm, your risk doesn't come from being in the consulting business. It comes from how risky your clients are. So if you're a specialized consulting firm that has only banks as clients, guess what? I'm going to use the beta for banks for you. But basically, I think the business you're in and the countries you're in, you have to think about where your risk comes from. But I would be careful about not getting too far down this rabbit hole because you might never get out. Hakan?
Yep, Professor. What about the company? Let's say the 100% of the revenues has been from the US, but they just announced they're entering a new market in a different region, and they shared all the. I
think you can answer this question for me. So basically, you start right now, you're 100% revenue. So for next year, when you compute the equity risk premium, you're going to use the US equity risk premium. You get to year 2. It's nothing that stops you from re-estimating every single number, right? They could be, it's not just equity risk premium, they could be in a different business. So basically, both the beta and the equity risk premium are open for you to change over time. And if you can change them over time, and you think in your story at least, your company is going to go from a domestic company to a global company. You know what you should be doing? Changing your equity risk premiums to reflect it. So the advantage of treating discount rates as year specific is you get to revisit the inputs each year and say, have things changed? Will things change? And bring them in.
Okay, thank you.
Any other questions? So now I'm going to talk about this lambda approach. I'll give you a little bit of the history. I said I concocted this measure, and I really mean I concocted this measure. Now, I've been teaching valuation seminars in Brazil now for almost 23 years. The first time I went to Brazil was in 1997. And this, in fact, 2020 will be the first year in a long time I haven't been to Brazil. So I remember this was about 2004, 2005. I was flying to Brazil to teach a valuation seminar. And I was taking the overnight flight from New York to Sao Paulo, and I couldn't go to sleep. So I pulled up the presentation I had for the next day, and I started reviewing what I was going to do. And I was looking at 2 companies, Embraer and Embep were my 2 Brazilian companies, my lab experiments. And at that time, I was doing what bankers did, which is, hey, they're Brazilian companies. I'm going to give them the Brazilian equity risk premium. I didn't know any better. And I had the annual report for both companies in my backpack. In those days, I didn't have a digital version. I actually had a physical version. So I open up the Embraer annual report. I start leafing through it. I come to a pie chart of revenues. I have a pie chart. And the pie chart shows 97% of the revenues come from outside Brazil, 3% from Brazil. I also happen to have the Boeing annual report. Don't ask me why I'm flying with all these annual reports in my backpack. I probably had no good reading to get. I didn't have Netflix then. Otherwise, I would never be reading annual reports. I pulled up the Boeing annual report and I opened up. There's a pie chart for Boeing. And basically, it says 97% of its revenues in the US and Western Europe, 3% from emerging markets. And I started thinking about the fact that for Boeing, I was using the US equity risk premium, and for Embraer, I was using the Brazilian equity risk premium. I said, this isn't fair. And in fact, if you open the Embev annual report and look at their pie chart, they were getting about 70% of their revenues in Brazil and 30% from outside. And I was using the same equity risk premium. So I concocted a proposition. I said, you know what? I would expect Embraer to be less exposed to Brazilian country risk than Embev. Do you agree with that? If you get only 3% of your revenues, we can think about how to divide. And another company gets 70% of its revenues. I would expect the company that gets only 3% of its revenues to be less exposed to country risk, to that country's risk, than the one that gets 70%. And I concocted this measure, lambda, to measure that exposure. Why did I call it lambda? I've discovered a secret. If you come up with something in finance, you give it a Greek alphabet. It adds this layer of sophistication that makes people want to, lambda, you know, if I called it L, people would have questioned. Lambda sounds so much more sophisticated. The only people who are not impressed by this are the Greeks. So why do you keep stealing my alphabet? I said, take it up with the option guys. They stole your alphabet first. So I land in Brazil. I am not slept. I'm in completely, you know, I don't even know what time zone I'm in. The time zone is actually the same time zone, but with no sleep. I show up in front of the session and I throw out this idea. I said, no, we should be measuring company risk exposure to country risk. And I said, let's call it lambda. And then one of the more practical people in the audience puts up his hand and says, how exactly are you going to measure this lambda? I said, I haven't thought about it yet, but I have a long flight back. I'll think about it then. In fact, I wrote a paper on this called Estimating Company Risk Exposure to Country Risk. That's on my website still, on the things I would look for to determine what your lambda should be. One of the things I'd like to know when I look at how exposed to country risk is, how does the management in the company use risk management products? Has it bought insurance against certain kinds of country risk? That'd be nice to know, right? How is this company viewed by the government? I'll give you one thing, one deadly set of words that will lead me to think you're more exposed to country risk. If your company is viewed as being in the national interest, the government says you're in the national interest. God help you, because now you're an extension of the government, right? Everything you do is viewed as an extension of the government. You're more exposed to country risk. So I said, I'd like to know where you get your revenues, where your production is, what risk management products you use, what the government thinks about you. Those are qualitative factors. But if you put me on the spot and say, give me a measure of lambda, I'm going to fall back on an old faithful. So if you get 3% of your revenues, or, you know, from Brazil, and the typical Brazilian company gets 60%, I'm going to take 3 divided by 60, which gives me 0.05, your lambda. It's simplistic, but it's easy to do, right? Take the percentage of your revenues you get from a market divided by what the average company gets, and you get lambda. So in the context of the Tata Group, which is an Indian group, you have Tata Motors, which is an Indian company, and Tata Consulting Services, which is part of the same group. But here's the difference. Tata Motors gets 91% of its revenues. This is in 2008 in India. Tata Consulting Services gets about 8% of its revenues in India. The typical Indian company gets about 80% of its revenues in India. See where I'm going to go? Divide 91 by 80, I get 1.14 as my lambda for Tata Motors. Divide 7% by 80, I get a lambda of 0.09 for Tata Consulting Services. Extremely simplistic. You need to know the average company's revenues domestically, but you can compute lambda. And of course, this is all based on revenues. There's a lot of missing by doing it. So in the paper, I started thinking about, are there better ways of doing it? You could look at operating income and net income over time. Because what are you saying? This company, if it's exposed to country risk, you should see its earnings go up and the country does well, and earnings go down and the country does badly. But I latched on to a measure that actually I stole from how we think about betas. When I ask you what's a beta for a stock, what do? We take the returns from the stock, regress it against a market index, right? The slope of the line is the beta, because it measures how much my stock moves when the market moves. I said, could I steal that concept and use it to measure lambda? Think about it. What am I trying to measure with lambda? How exposed is my company to changes in country risk? So here's what I did. I ran regressions of returns on the stock. In this case, and if you look at Embraer and Embratel, 2 Brazilian companies, I ran regressions But rather than run them against a market index, which would give me beta, I ran them against a C bond, which is a Brazilian dollar denominated bond. Today, I'd run it against a sovereign CDS, right? Because you have a measure of country risk. And you say, what does this tell me? It tells me how, as the C bond does, how does my stock do? For instance, if you look at Embraer, for every 1% increase in the C bond, so C bond does well, it goes up by 4%, Embraer goes up only about a quarter of that. So if the bond is up 4%, Embraer is up only 1%. Why? Because Embraer is a company that's not that exposed to country risk. But in contrast, if you look at Embraer, for every 1% increase in the C bond, Embraer goes up twice as much. It's twice as exposed to country risk, both in good ways and bad ways. The lambda then becomes the slope of that line. So the lambda for Embraer becomes 0.27, and the lambda for Embraer becomes 2.00. Having said all of this, the only times I use the lambda approach is if you gave me a truly exceptional company, an unusual company, which is exposed to risk from one country because it's part, but it gets its revenues from developed markets. You say, what is the risk of this company? I might focus my attention on the lambda. But if you gave me a company which is in 7 emerging markets, can you imagine what a nightmare it would be to compute lambdas against each one? Because you'd have to do this for each market separately. So for 95% of companies, I don't even open the lambda book. It doesn't work. I'm just going to go with the weighted average equity risk premiums across countries. But if you have one of those companies, a big company, it's a center of the market, and you say, well, can I isolate how exposed this company is to the country, just this country's risk? Try the lambda approach. It's actually a pretty interesting opening to thinking about country risk in general. And as data gets richer, you should be able to do it a little more easily. So let's see how these approaches would play out in your cost of equity. The end game here is to get a cost of equity. I've given you, different ways of computing the equity risk. You can do it with betas, with lambdas. Let me take Embraer in September of 2004 and show you how the numbers would be different using the different approaches. If I use the standard investment banking approach, I'm going to treat, and this was in 2004, the country risk premium for Brazil, the extra amount I was charging was 7.89%. This was about 2 years after Lula had been elected. The country was viewed as very risky. The equity risk premium was huge. The 7.89% is the additional risk premium. In the first approach, here's what I do. I'm going to do all of these in US dollars, simply to keep them as a constant. So I'm going to start with the same risk-free rate in all 5 of my calculations. It's a T-bond rate. And the T-bond rate in 2004, this is the US T-bond rate, was 4%. That's my risk-free rate. The beta that I used for Embraer, and I'll come back and talk about how I got it, was 1.07, slightly more risky than the average stock. It's an aerospace company. In the first approach, here's what I do. I start with the risk-free rate. I multiply the beta by the equity risk premium for a mature market, that US premium. That's a 5%. And then I add the 7.89%. Why? It's a Brazilian company. I'm going to punish it by adding the 7.89%. Think of this as the bludgeon approach. You add the country risk premium to every company in the country. In the second approach, here's what I do. I use a weighted average equity risk premium. The weighted average equity risk premium is 3% of my revenues come from Brazil, 97% from the US. The US has no additional country risk premium. That gives me a much lower number. Notice just the first 2 numbers. They're both in dollar terms. If I use the bludgeon approach, I get 17%. If I finesse the equity risk premium to reflect where revenues come from, I get only 9.6%. And in fact, that's going to be the dividing line. Any approach where I punish Embraer for being a Brazilian company by giving it the entire Brazilian equity risk premium, I'm going to come up with numbers like 16, 17%. Any approach where I factor in that their revenues come primarily from the US, I'm going to come up with lower numbers. That's 9% or 10%. That's going to make a huge difference in your valuation, right? Think about valuing Embraer in dollar terms using a 17% cost of equity versus a 10% cost of equity. You're going to get widely different numbers. In fact, with the 10%, I'm going to get a much higher value for Embraer than with the 17%. You're saying, so what? There is a truth that we all search for. We could use any approach, but there's a truth that the market is building in. The question is, what is that truth? Is it that every Brazilian company is equally risky and gets punished the same? Or is it that the market is able to discriminate across companies and punish some companies more than others. And here's why it matters. Let's assume that everybody else does what the standard approach is, which is to punish every Brazilian company by giving it the entire equity risk premium, every Indian company by giving it the Indian equity risk premium. And you believe that this is wrong. I mean, of course, you can't prove it, but you say, I think that's wrong. I think TCS and Embraer are less exposed to country risks than Tata Motors and Embraer. Is there a way you can take that view of the world and convert it into an investment strategy? In fact, let me give you two very specific strategies. You tell me which one would make sense given your point of view, which is that risk premium should reflect where you do business, not where you're incorporated. Will it be that emerging market companies with significant exposure in developed markets will be overvalued by analysts or undervalued by analysts, given that they're using just the country risk premium for every company? Companies like Embraer and TCS, will they be under or overvalued by analysts? Anybody want to give that a shot? So you see what I'm saying? Analysts are just taking the bludgeon approach. They're taking every Brazilian company, giving it 7.89%. Every Indian company giving it the Indian equity risk premium. And you're looking at companies like Embraer and TCS that get the bulk of their revenues outside the emerging market from a developed market. Are these analysts going to under or overvalue those companies?
Under?
Yossi?
Yes, for sure undervalued because they're using the higher discount rate.
They're going to come up with a lower value, right? Undervalue basically means the value is higher than the price. They're going to push down the value because they're using too high a discount rate. They're actually going to put sell recommendations to these companies, right? So, because the discount rate is too high. But you believe they're wrong. So,
Yes, right.
So what should you do? You're going to buy these companies or
buy these companies? Yeah, I'm going to buy these companies.
Buy these companies, and then what becomes the part that you have to hope and pray will happen? That the market will eventually discover that it should be doing the right thing and push the price up.
Professor,
yeah, go ahead.
Sorry, so what about the bond market in those markets for these companies? There should be also,
you could use the same argument, right?
So I'm saying, so in the bond market, you don't have to wait for the market to realize that. You can just gain from actually holding that because they're more secure.
And that's actually a good point, right? Do you see what he means by the bond market? If you bought an Embraer bond and people are pricing the bond because it's a Brazilian company at a very low price, and you know that the bulk of their revenues are in the US and their dollar revenues are much more predictable and stable than a typical Brazilian company, Yossi's point is you could buy the bond, hold it through maturity, collect those higher cash flows, and earn a much higher return than investing elsewhere. With the equity market, though, you got to wait for a correction, something that makes the market realize it's made a mistake. I actually bought Embraer in September of 2004 because I felt it was undervalued, but I felt it because I was using the lower discount rate. It took a long time, but here's how the realization played out in the market. Brazil would have its ups and downs. Brazil is a country where we have good years and bad years. And what the market started to notice is that the earnings at Embraer were surprisingly stable no matter what. I'm not saying the market woke up right away. It took a while for it to build in. And it actually took a quarter where Brazil had a catastrophic quarter. Something terrible happened, country risk soared through the roof. Embraer comes out with an earnings report and its revenues are up 6% and the margins are up. In fact, it was reporting a better quarter than ever because all of its cash flows were in dollars, and when the real collapsed, it actually looked better. It took about 4 years before the recognition. And since then, I've maintained a list. And here's what I do. I go through markets and I pick a company that I really like in that market that gets a bulk of its revenue. So basically, these are emerging markets. I go to Vietnam, I look at Vinamilk and say, you know what, I like Vinamilk as a company, but not at the price today, but I'm going to watch it. And here's it's an investment strategy. Wait for a crisis in that market. You're saying, what if there's no crisis? It's an emerging market, not a question of whether, it's always a crisis. And in a crisis, what do most investors do? They sell everything and they run for the exits. So when you have a crisis, everything gets sold off. The good companies, the bad companies, the Embraers, the Embraers all get caught in the sell-off. And if my end game is right, that is my time to buy Vinamilk. It's been a strategy that's given me maybe 5 or 6 companies over the last 20 years. It doesn't happen that often, but it's something worth thinking about. If you think that this is something that markets are getting wrong, you're trying to take advantage of it. But remember, it's not a riskless strategy. It's not arbitrage by any stretch of the word. It's a strategy where you believe the market is making a fundamental mistake and you're trying to take advantage of that fundamental mistake. Any questions?
Professor, I have a quick question.
Yeah.
So would the opposite be true regarding operations? Or
Yes. Yeah, you take a US company with substantial emerging market operations, you treat it like a US company, you're going to get a slap across the face one day when you wake up and say, oh my God, what happened? It happened, you know, when Coca-Cola in the late 90s, when Russia had a meltdown, Coca-Cola had a really bad quarter because of their Russian operations. And people said, but it's a US company. I said, where were you looking? I mean, it's right there. You were just choosing to ignore it. So one of the things that you're looking for in a US company is the exact opposite effect, which is, are these companies being overvalued because people are not factoring in that 80% of the revenues come from Indonesia? Or worse still, if you go to North Korea. I don't know, there are very many US companies with North Korean operations. But I think the exact opposite, so that's exactly true. You would look at the other side of the equation as well, because you're looking at where the revenues come from. So you can have companies that are in safe markets that are actually very risky because of where they do their business. And in the US, there's an added factor to consider. Many US companies, their operations are actually in some of the riskiest parts of the world, their factories. So half of Microsoft's software is written in Bangalore. If India goes to hell in a handbasket, I'm not suggesting it will, well, guess what? Your spigot of software is going to get stymied very quickly. So what I think we all need to do is be aware of the fact that what we have are not US companies or South African companies or Indian companies. We have multinationals that happen through the accident of history to be incorporated and traded in some part of the world. And we need to treat them as multinationals whose risks come from where they operate. Any other questions?
Professor, I have one question. So, you sort of mentioned the debt market and how this, like Yossi mentioned that, this might be that might reflect differently in the debt market, but wouldn't they also sort of look at the revenues and see, like, wouldn't that also reflect the fact that they, some of the revenues come from?
Yeah, what's the difference between the debt and the equity market? Let's go through it first. First, debt is a finite maturity, which is, there's a day of reckoning, right? Face value being due. So when you talk about arbitrage in the bond market, what you're effectively doing is you're saying, look, I'm going to buy something mispriced. And if it's seriously mispriced, that mispricing has to disappear by the maturity date, right? If you're right about emerging market companies getting the bulk of their revenues outside that emerging market being safer than other companies in that same market, the bonds issued by those companies, if people are not pricing that in, will be trading at too low a price. So you're going to pay that price, and then you're going to sit there and just collect your cash flows. Some of those companies might still get in trouble, but a far smaller percentage than the market is anticipating. So if you look at your portfolio of bonds in these companies, the collective cash flows you get will deliver a return much higher than you should be making given the risk, because people are not pricing it in. But the reason you can then lock it in is there is a day of reckoning. By that expiration day, the mispricing has to disappear. If you collect the entire face value, what does it matter whether the market agrees with you or not? You've collected your cash flows. That's why fixed income arbitrage exists. Equity arbitrage is an oxymoron. You cannot have equity arbitrage. Something that even the big hedge funds sometimes forget. If you get a chance, read When Genius Failed. Have any of you read that Roger Lowenstein's book? It's an amazing book. It's about the book of long-term capital management. LTCM was founded in the 90s, Nobel Prize winners on the board, essentially founded to take advantage of arbitrage, built their reputation by doing fixed income arbitrage, but then got so big that they decided that they would try equity arbitrage. And there's no such thing. They might be good investments, right? But they're not arbitrage. The essence of arbitrage, it has to be riskless. I can take a fixed income bond and make it riskless because all I need to do is lock in the cash flows and collect my cash flows at maturity. Equity, there is no maturity. There's a pricing mistake. It might never disappear.
Okay. Yeah, I think I got that.
Okay. Kushal?
Yeah, Professor, going back to your Embraer example, does it matter where the company is primarily traded? So like Embraer's, no?
Yeah, I don't think so. It might mean that the price correction takes a while longer, but I am not, I mean, unless you believe that somehow US traders are more rational, we're all traders. We all do rational things. So I think that the correction might take a little longer if there's less liquidity. But I think it's going to happen, and no matter where it's traded. I'd like it to trade in a nice liquid market because there the correction is going to happen a little sooner. But even if the market, if it's traded only in Sao Paulo, the realization will still come that the earnings are being stable even though the country is melting down. So I don't think it's going to make a substantive impact on my portfolio, if it's traded in multiple markets as opposed to a single market. It does make it a little more difficult. For me to buy Vinamilk is a lot more work than for me to buy Embraer. Because Embraer, I can buy an ADR. Vinamilk, I actually have to find a way to buy a stock that's listed and traded only in the bid. So it might be, that might be the biggest challenge, is how the heck do I even buy these shares given all those barriers I've got to get through. But outside of that, it's a secondary factor. Any other questions? Michael?
Yeah, Professor, you mentioned that there wasn't any equity arbitrage, but when there's an M&A deal and a company's buying another one for a certain, stock amount.
Merger arbitrage is a complete misnomer. What do you do in merger arbitrage? You play the odds. We know that 90% of mergers go through. And if the price is up only 80%, you bet on it by going and buying the stocks and expecting. But the 90% is not a guarantee. Merger arbitrage might be informed speculation. That's what I would call it, merger speculation. But people don't like to use the word because arbitrage just sounds safer. So this whole notion of merger arbitrage is an oxymoron. That's why you often hear of people losing tens of millions of dollars in a supposed merger arbitrage because the merger fell apart at the last moment. That already proves it couldn't have been arbitrage in the first place.
Understood.
You're playing the odds. It might be good odds, but it's still you're playing the odds. Okay, so let's talk about a different way of thinking about equity risk premiums. And if you've heard me say this before, it's something, it's a message I keep coming back to. I don't like historical premiums. Why? They're backward looking, they're static. I'd like a forward looking dynamic estimate of the equity risk premium. You say, how are you going to get that? Very simply by looking at what you pay. When you tell me what you pay for an asset, you've told me what your equity risk premium is, right? What you demand is an expected return. Because I can take the price, I can take the cash flows. So with the bond, you know how this plays out? You tell me the price of the bond. You give me the cash flows, I can compute a yield to maturity. We do this all the time in the fixed income market. It's based on promised cash flows, but it's based on future cash flows and what you pay today. So about 30 years ago, I started thinking about an alternative to historical risk premiums. I said, I don't like it, but I need something to replace it because without something, people are going to go back to the past. So I said, can I take what I do in the bond market and apply it in stocks? In other words, the way I compute yield to maturity is I take the price of the bond, the cash flows, and I solve for an IRR. Can I do that with stocks? And my reaction was, why not? I know what you paid for stocks. If you tell me what you paid for the S&P 500, that's what you paid for stocks. Instead of coupons, what do you hope and pray you will get as cash flows if you buy the 500 largest market cap stocks?
Dividends.
Dividends. And in the US, increasingly as a side, you're going to get buybacks. If you owned all the stocks, the buybacks would come to you. You know what that number was last year, but unlike a bond where that number is fixed in the future, you have to make expectations, but you can make your best estimates of future cash flows. But at the end of the process, here's what you have. You have the price for the index, you have the expected cash flows, and I should be able to compute an internal rate of return that makes the present value of my cash flows equal to the level of the index today. It's not rocket science. There's no model there. I'm just taking what I do in the bond market to the stock market. So let me show you what that number looked like way back in time, start of 2008. Now, you know what came in 2008, right? I won't claim that I knew what was coming. The start of 2008, I was as oblivious as the rest of the world that a correction was coming. On January 1st, 2008, the S&P 500 was at 1,468.36. So I did what I just described. I took the cash flows and I projected them out into the future. And I solved for an internal rate of return. So if you look at the equation, that's just what you see on the left-hand side of the equation, 1468.36 is what the level of the index is. The cash flows you see for the next 5 years are expected dividends and stock buybacks. You're saying, what is that last term in there? You know what that last term is? At the end of year 5, you continue to get cash flows on stocks, right? For how long? Forever. But you can't assume your growth rate is going to be higher than the growth rate of the economy forever, because then your stocks will overwhelm the economy. So after year 5, I set the growth rate to what I believe the growth rate of the economy will be. You're saying, how the heck are you going to get that? I cheat. And I'll cheat repeatedly doing this. Whenever you put me on the spot and ask me to estimate a nominal growth rate for the economy, I'm going to use the risk-free rate as my proxy. Why? Because the risk-free rate is embedded in expected inflation and expected real interest rate. And over time, that's as good a prediction for the economy as I can get. So the last term basically means after year 5, my cash flows will continue to grow at 4.02%, which is the T-bond rate then, forever. I have everything I need. All I need to do is solve for the R, right? It's a little messier than a bond because that last term is going to be a function of my discount rate. But if you use the solver function in Excel, you can solve for the R. And that's basically what I do. Either the goal seek or the solver function. What I get as my R is 8.39%. What does that tell me? At the start of 2008, if I asked you what your equity risk premium is, you could give me a number, 7, 8, 9. But I'm not going to listen to you, because rather than listen to what you say, I'm going to look at what you pay. And given what you paid for stocks, you can expect to make 8.39% a year for the long term as your expected return. T-bond rate is 4.02%. You take the difference, you got the equity risk premium at the start of 2008, 4.37%. Of course, during the course of the year, bad things happened. 2008, last quarter, was when the market collapsed. Start of 2009, I decided to do the implied equity risk premium again. So let's look at where we are. Remember the S&P 500 was at 1468.36 a year ago? Now it's down to 903.25. It's been a horrific year. That was 2008. So stocks have dropped. Earnings and cash flows have also been affected. The economy is in a recession. We don't know whether it'll come back. So you'll see my earnings and cash flows numbers are low. But if I adjust both numbers, lower level for stock prices, lower cash flows, and I do the same thing I did at the start of 2008, my expected return actually doesn't change that much. It's gone from 8.39 to 8.64%. But look at what's happened with the T-bond rate. Down to 2.21%. My equity risk premium at the start of 2009 was almost 6.4%. What happened? A crisis happened. Why does a crisis affect your equity risk premium? An equity risk premium is the price of risk. And if you're more scared, guess what? That number is going to be higher. And much of the change actually happened during the last quarter of 2008. The last quarter of 2008, I started a practice that I still continue to follow. Whenever I'm in a crisis, one of the things that I use to kind of center myself, to kind of get back balance, is to compute the implied equity risk premium every day. Trust me, it sounds like a terrible thing to do, but actually it gets me away from all the experts and the market gurus telling me what to say. Hey, what's actually happening in the market? And the nice thing about implied equity risk premiums is you can do it on a daily basis. Every time the index changes, your equity risk premium is changing. How much? Take a look. At the start, on September 12th of 2008, for those of you who don't remember, that was the Friday before the Lehman collapse. The implied equity risk premium in the US was about 4.3%, 4.4. And over the course of the next 12 weeks, take a look at and you can see it in the green line in this graph. Take a look at what the equity risk premium did. There was a day in November where the implied equity risk premium in the US got almost to 8%. It almost doubled in 2 months. This is the US, the S&P 500, the US equity risk premium almost doubled. It dropped back a little by the end of December, but it was still at 6.4%, well above where it was before the crisis. The equity risk premium changed dramatically during a crisis, which is what you'd expect. But the problem is if you're using historical risk premium, nothing changes, right? Because you're looking at the past. The world is shifting under you. How can you keep using 4.5% as your equity risk premium when the world is pricing things with a 6.5% equity risk premium? So let's bring this up to the start of 2020. Again, I had no idea COVID was coming. I'd love to tell you that I had this premonition that terrible things were going to happen in 2020. I had absolutely no idea. In fact, while I was doing this, I was getting the lecture notes ready for last year's spring semester class. I was expecting to fly out to New York, teach for a whole semester, best laid plans of mice and men kind of thing. Started 2020. I did the implied equity risk premium for the US. And by now you see what I do, right? I take the level of the index. I project out expected cash flows by looking at dividends and buybacks. And I solve for required rate of return. Start of 2020, that number was 7.12%. What investors were expecting to earn, given where stocks were priced, was 7.12%. You subtract out the T-bond rate then, 1.92%. The equity risk premium at the start of 2020 was 5.2%. So we come into 2020. And of course, on February 14th, we get that news story out of Italy saying, I mean, until February, I don't know why, we thought this was a virus that was going to stay in China and cruise ships. If you remember the news story, oh, this is not a big deal. And of course, February 14th, we woke up to a nightmare. And for the first 5 weeks, February 14th through March 23rd, we were in complete meltdown. The S&P 500 was down 30%. People are heading for the hills. This was the end. And take a look at what happened to the equity risk premium in that period. It went from about 4.3% to almost 8%. Looks a lot like 2008, right? Now do you see why people keep saying, is this like 2008? It looked a lot like 2008. On March 23rd of 2020, the implied equity risk premium in the US was 7.75%. And then the rest of the year unfolded. And here's the difference between what happened in 2008 and what happened in 2020. Remember in 2008, the equity risk premium dropped back from the highs, but it stayed well above what it was before the crisis. Because it was 4.3% before the crisis, it ended the crisis at 6.4%. In 2020, the equity risk premium fell back to where it was before the crisis. In fact, it ended the year at a level lower than it was at the start of the year. So if you look at the 2021 equity risk premium, you have a much higher level of the index, 3,756. So this isn't 2008 and 9 where the market collapsed. Here the market actually went up. Earnings and cash flows were much lower for 2020 and 2021. Why? Because you have the economy being shut down, and I factored that in. If I solve for an expected return based on what people are paying for stocks, which is much more than they were at the start of the year, and what they were getting as cash flows, which is actually much lower than it was a year ago, I get a fairly troubling number. I get 5.65%. Just to give you perspective, do you remember what that number was in 2008? It was 8.4% and it jumped to 8.6%. It's been about 8% for most of the last 20 years. Started 2020, dropped to 7.12%. Started 2021. Investors were pricing stocks to earn about 5.65% a year. You know what, 30 years ago, if I went to a portfolio manager and asked, would you invest in stocks if I told you you'd make 5.65% a year? There was zero chance a portfolio manager would invest in it. Why? The T-bond rate was 6%. So why would I invest in stocks to make 5.65%? Even 20 years ago when the T-bond rate was 4%, if I offered you 5.65%, you say, that's not enough. I can make 4% without any risk. So you say, what's different about 2021? Why were people willing to accept this lower return? Because that's the only way you can explain prices. You got to live in the world you're in. If you don't invest in stocks, what are you going to invest in instead? Or T-bonds? At the start of 2021, you were making 0.93%. You're making a premium of 4.72% over that, but the number is much lower because you're building off a lower base. And one of the questions, of course, is, is that equity risk premium enough? Because every question about markets can actually be translated into a question about equity risk premiums. If you tell me that stocks are overvalued, you're basically telling me the equity risk premium is too low. If you tell me stocks are undervalued, you're telling me the equity risk premium is too high. So of course, you've probably been reading every day I get at least 4 or 5 articles forwarded to me about the market being in a bubble. It's usually from the same guy. I think he writes like 5 articles every day. The market's in a bubble, the market's in a bubble. I've been reading him for 10 years. He's been telling me the market's in a bubble for the last 10 years. But there's a lot of talk about bubbles, right? A lot of people, and Leon Cooperman thinks we're in a bubble. Some big name investors think we're in a bubble. So one of the questions I always have is, are we in a bubble? How would I know if we're in a bubble? Well, one way is to look at that equity risk premium that we have right now, the implied premium, and ask, does that number look low or high? Relative to what? Relative to history. So let me give you the first graph, and you tell me whether the equity risk premium at the start of 2021 is a number that's going to make you freak out as being too low. Remember, too low means the market's in a bubble. At the start of 2021, the implied equity risk premium was 4.72%. Well, I've computed this implied equity risk premium, this graph going all the way back to 1960. The average from 1960 through 2020 is 4.21%. If I stopped right there and asked you, are you okay with 4.72%? Well, that looks pretty good, right? You're actually earning more than historical numbers. So now, if this had been 1999, I could see why you worried about a bubble, because in 1999, the implied equity risk premium was down to 2%. If you told me market's in a bubble, I'm willing to listen. But at 4.72%, you're higher than the average. It's true that that number is lower than what it's been for the last decade. Last decade, it's been about 5.5%. So maybe if you want to tell me that stocks are overvalued by 15%, you can make a case that given how stocks have been priced since the 2008 crisis, stocks look overvalued. That's not a bubble story, that's an overvaluation story. But if I just looked at the equity risk premium, there's nothing there that leads me to put red lights going off, get out of stocks now. And I did this graph as one of my first posts this year. I said, look, just based on the equity risk premium, I am okay with this premium. But I'll tell you the number that bothers me. Remember that 5.65% that I showed you? That's a total expected return, not just the risk premium, adding the risk-free rate. That number is at a historic low. It's way lower than it was in the last decade, the last 20 years. In fact, the number has never been lower in all of the 60 years of history that I've looked at.
Professor?
Yes.
Yeah, the point of a bubble is not that the market is in a bubble, that there's some sector in the market that are actually undervalued and others that are completely overvalued.
That's always true, right? You can't use the word bubble for that. You could just say sectors are overvalued, sectors are undervalued. But I actually have heard a lot about the market being in the bubble. Maybe you're listening to, I hear it all the time, investors telling me market's in a bubble.
See, no one implies that the energy companies are priced too high, but everyone.
I think if you look at relative multiples, energy companies are actually priced much higher than they were 10, 20 years ago. There isn't a single sector where we look at the multiple of whatever you used to use as a metric. Numbers don't look much higher than they've been historically. Right? You could say they look low relative to tech companies, but you're still paying 12 times EBITDA and you used to pay 7 times EBITDA. Saying, what the heck is going on here? So you can say some sectors are even more bubbly than others. Let's use that word. But the sense that people get is the entire market seems to be mispriced. So that's why when you look at Schiller P's, you look at price to book, any market-wide metric, if you try to look at history, you're saying that doesn't make sense. That number looks too high. I'm not saying I buy into that, but I'm saying that is the argument that's being used. And I'm trying to dig a little deeper into why we're seeing much higher multiples. And the answer is not because equity risk premiums are too low. It's because the risk-free rate has imploded. The big question for this year is what will happen to that 10-year T-bond rate. Imagine if that rate goes from 1% to 3%. All of a sudden, you're looking at a number that's dangerously low in terms of equity risk premiums, right? If stocks are continuing to price as they are, 5.65%, the T-bond rate climbs to 3%. Now we're in 1999 type territory. So to me, the biggest danger to stocks comes from interest rates climbing dramatically over a short period. What's the pushback you get? What's the defense that market bulls give to that? Jerome Powell will never let that happen. Come on, guys. We talked about central banks. Jerome Powell can want whatever he wants, but if inflation goes to 4% in April or May, I'm not saying that that will happen, but if that happens, the T-bond rates are going to take a ride up and stocks are going to be down. The biggest danger to stocks doesn't come from how they're being priced relative to bonds, but that bond rates themselves will start climbing if there's some underlying fundamental that causes it to.
Also, Professor, another point.
Yeah.
The quality of cash flows also went down because we have many companies
that makes it even worse then, right? Because then you're accepting a lower rate of return for lower quality cash flows. That'll make you more concerned.
But that makes it a bubble because 10 years ago, the companies in the market at much more higher quality of cash flow than today, the EV, let's say,
what's
market.
the measure of quality of cash flows? What do you mean by more
Let's say a tech company doesn't even have any revenue. The market expected.
What's the biggest cash machine in history?
Apple, you said it.
Apple. $300 billion in cash over the last, you could take an entire manufacturing sector. So it's true there are some parts of the tech business where the cash flows are all over the place, but the biggest tech players have had the most stable cash flows in history because they have high margins and very little reinvestment. GM never had it this good at the peak of its glory. So I think that you're right about the quality of cash flows. If you go past that, maybe the smaller tech companies, but it's really not that their cash flows are high and they're often negative. We're combining companies with negative cash flows with positive cash flows. And you worry about the fact that those negative cash flow companies could kind of implode on you. So I think the quality of cash flows argument can be made, but it has to be based on actually looking at have earnings become more unstable over time. And as I look at the aggregate earnings for the S&P 500, I don't see any evidence of that. In fact, earnings used to be more unstable, more volatile before tech than they were after tech. So it might be that the cash flows are not as sustainable. Maybe that's the argument to be used as tech companies flare out. You can go from having really high cash flows to nothing. And maybe that's a concern we should be building in, and we're not building in it sufficiently. But I think so what the advantage of the implied premium approach is you can pick your poison and say, this is what I'm worried about. Let me stress test it. So maybe your worries about cash flows, go into the calculations and say, hey, what if cash flows drop by 20%, 40%, 30%? What would I earn as an equity risk premium? Because it then isolates what you're most afraid of. It's cash flows falling, in which case what you should be watching are earnings reports and cash flows coming out of those earnings reports to see signs of an incipient collapse. Manav?
So Professor, like I understand the risk-free rate will probably rise towards the end, or the hypothesis would probably rise by the end.
If we knew that, we'd be all selling short on bonds, right? So that cannot be a consensus view, because the consensus view has to be that rates are not going up, because if we all expected rates to go up, they'd go up right now.
Right. So no, but we also expect the cash flows will also increase, the growth rate for the cash flows as the economy improves.
I'm saying the first part of it is not a we, it's a you.
Okay.
right? And the reason and I'm being very clear about that, because here's what, if we all thought rates would be up to 2% by the end of the year, the rates would go up to 2% right now. Why? Because you'd be crazy to go buy a bond at 1% knowing the rate's going to go. So the consensus view on rates actually is that rates will stay low. And the consensus view is earnings are coming back. And my problem is those two consensus views might be at odds with each other. Because what will cause earnings to come back is the economy coming back strongly. And the economy comes back strongly, how the heck can you keep rates at 1.1%? So I wouldn't have a problem if rates went up and cash flows going up, because you're right, they offset each other. But right now it seems to be the markets are buying into this Goldilocks scenario of the economy will come back, there'll be growth, the cash flows are going to be great, but Jerome Powell will keep rates at 1.1%. Already, what have we seen since the start of this year? We started the year with the T-bond rate at 0.93%. It's already up to 1.15%. Rates are on their way up. For the moment, the market seems to be looking past them. But as I said, that's the number I'd be watching, because that's where I see an inconsistency. Laura?
Yeah, I'm struggling with a little bit of things that seem to be competing with each other in my mind. I want to clarify with you. So if what we're saying right now is the ERP plus the risk-free rate is at a historic low, then doesn't that assume that we potentially could be overvaluing returns in the future? But if we also see that—
No, overvaluing only if we ignore the fact that we don't have any opportunities. Because remember, the essence of overvaluation is you're going to take your money out of stocks and put it somewhere else.
Oh.
Right? The question is, where are you going to go right now? Right now, everything is down. So in a sense, this is the world you're in. You can take 5.65%, or put your money in cash and make nothing, or put your money in T-bonds and make 1%. None of them look attractive. But maybe this explains why a segment of the market is putting its money into Bitcoin, saying, I'm going to go Bitcoin, this whole thing is gone out of control. But I think that's the reality we face right now. So here's how I'd state it. Given where bond rates are, stocks look okay, given where bond rates are. But if you take that given where bond rates are out of the equation, then you really have an issue of what exactly do you do? Because I think that's why I think the focus should be on the bond rate, because until that number comes to a higher value, this is the best you can do. Earning 5.65% sounds awful until I tell you, if you don't do that, you're going to make 1%.
And then just a quick follow-up, is there a safe way to slowly increase that bond rate?
Right?
No, okay.
See, this is the problem. Bond rates are set by demand and supply. That demand and supply is driven by what people observe. So if people observe inflation going up quickly, then they're going to just immediately, right? So if you're one bad inflation report away from bad things happening in the bond market. And if bad things happen in the bond market, the question is, how does that play out in stocks? But a lot of people live in this bubble of Jerome Powell sets rates. And if you believe the Fed sets rates, then they will do it safely. They will adjust to 0.02% every year, every day, or but they don't. And that's, I think, why this Fed worship is so dangerous, because it leads you into this belief about, if somebody out there can keep rates going at this gradual pace. Now, I don't think that's true. Yeah. But we'll find out, right? This is an empirical statement. We'll find out. Jonathan?
Yes, sir. Professor, I was curious, could you use the implied equity risk premium to tie a contrarian asset allocation strategy to it?
Yeah. In fact, if you could comply to implied equity risk, implied risk premiums in different markets. In fact, that's what I'm going to talk about next, and you hold off because it will talk about asset allocation based on the price of risk in different markets. In fact, let's take the first market. You have a choice of investing between equities and corporate bonds. In the equity market, the price of risk is captured with the implied equity risk premium. In the bond market, the price of risk is captured with a default spread. In this graph, I put both of them in the same graph and computed a ratio. See the green column? That's a ratio of the equity risk premium to the bond default spread. I'll give you a number. It's 2. What is that? If you look at the history over the last 60 years, the equity risk premium has roughly been 2 times the default spread on a Baa rated bond, an investment grade bond. So if you were earning a 2.5% default spread in a bond, if you believe history, your equity risk premium should be 5%. You see how this can be a basis for allocation? Equity risk premium right now is 4.72%. The default spread on a bond, I think, is about 2.2%. The ratio is about, just it's pretty close to the historic average. So if you were looking at these two markets, you can say, you know what, they look at roughly where they should be given history. Equity risk premium divided by the default spread. But there have been periods in the last 30 years where the two markets have diverged. I'll give you one example. In the late 90s, the implied equity risk premium dropped down towards 2%. Okay. See that 1999? The red line is the equity risk premium. It's dropped all the way down to 2%. And a Baa default spread bond in 99 had a default spread of 2%. So you could either invest in equities and make 2% or buy this investment grade bond and make a 2% spread. If you're an asset allocator and you are actually following these numbers, you know what you'd be doing, right? You'd be selling equities at the peak of the dot-com boom, putting them into corporate bonds and locking in. That's right. It's been a good thing to do. In hindsight, everything is always obvious. That was the great dot-com boom. You saw that disconnect in markets. The bond market was much more rational than the equity market was. Then you get to 2004, 2005, 2006. Notice that the opposite happens. The equity risk premium stays, the red line stays high. But if you look at the bond default spread, it drops dramatically. This was the Greenspan put after the 9/11 attack. And Greenspan says, we're going to do everything in the Fed to keep the bond rates low, and it kind of played out as default spreads dropping across the board. So you look at 2006 or 7, equity risk premiums are high, but default spreads have fallen to historic lows. Again, if you followed the numbers, what would you be doing? You'd be taking your money out of bonds and putting them into equities. On a relative basis, that would be the right thing to do. But the 2008 crisis saw the correction again. The bond market corrected actually more than the stock market did, and the ratios returned back to normal. What I'm trying to say is most of the time, the two move together. When the equity risk premium goes up, the default spreads go up. In 2020, for instance, both default spreads and equity risk premiums kind of moved in lockstep through the year. They zoomed between February 14th and March 23rd and both dropped off. But there are times when they disconnect, and when they disconnect, you can use it as a basis for asset allocation. In fact, let me do one final asset class before we close this particular topic. The equity risk premium is the price of risk in the equity market. The bond default spreads are the price of risk in the corporate bond market. Any of you with a real estate background here? You know what a cap rate is in real estate? Anybody have a? Ali, what's a cap rate in real estate?
It's the rate. I literally just had to write a paper about this. Right. It's the rate at which you make back your investment, your original investment. It's
basically a rate you use to take the earnings you have on a rental property and convert it into a price. That's what it's basically like an expected return on real estate that investors are demanding. You see where I'm going to go next? If I take the cap rate and subtract out the risk-free rate, I get a risk premium in real estate. So the equity risk premium measures what I'm getting in the equity market, the bond default spread, which is measuring what I make in the bond market, and the cap rate minus the risk-free rate, which is measuring what I make in the real estate market. Remember, all of us as investors have choices, right? We can invest in real estate, we can invest in stocks, we can invest in corporate bonds. Let's bring all three into the same graph. Take a look at real estate risk premiums. In the 1980s, the real estate risk premium was actually negative. And we were okay with that. You know why we were okay with that? When I did my MBA, I was told that as an investor, I should buy real estate to diversify my portfolio. Because real estate moved in the opposite direction as stocks and bonds. And that was true. In 1981, that was actually the case. You remember the 1970s, during inflation, real estate was one of the few asset classes that held its value. And we listened, right? In addition to buying houses, which is the traditional way investors put money into real estate, we also look for real estate securities. Lou Ranieri created mortgage-backed securities. You securitize real estate to allow people to be able to hold real estate in their portfolios. And that, in a sense, almost demolished real estate as a different asset class. Because take a look at what's happened since the 1990s. Real estate risk premiums are moving with stock and bond premiums. What does it mean? Terrible things if you're an investor or anybody who's invested, because here's what you will see. You have a bad year in stocks. And you say, oh my God, let me go check my corporate bonds. A bad year in stocks, you're also probably going to have a bad year in corporate bonds. Lots of default. This, at least my house held its value. Go check your house. Guess what? If it was a bad year in stocks and bonds, your house is down 20% in value as well. It's become much more difficult to find a safe place. This is one of the problems with securitization. We do it with the best of motives, right? We securitize things because we want to give people a chance to invest in things that move differently than the rest of your portfolio. And in the process, we create things that start to move with stocks and bonds. Real estate now behaves like a financial asset, which effectively means you no longer have the luxury of saying, I have a house, therefore it's going to be safe for me, because your house, the price of your house is hurt at the same time that your portfolio is hurt. If you get a chance, look at the correlation matrix I reported in my, I think my third post this year. That's a correlation matrix across every conceivable asset class: stocks, bonds, real estate, gold, silver, Bitcoin, throw everything in the mix. And here's what I see. Everything kind of moved together in 2020. The only exception was gold. Bitcoin moved like very risky stock. So in April, I remember in March of 2020, I got more calls from relatives than I have in probably a decade. Every time there's a crisis, I get say, where do I go? What's a safe place to go? And I had to tell them the truth. There is no safe place to go because everything is connected at the hip. It's one of the dark sides of securitizing everything and globalizing everything is we've kind of created these things that all move together. One final question, and I'll leave you with this question. A lot of equity research departments pick an equity risk premium. I don't even know where it comes from. They use 6%, 5%. It's like locked in. Let's assume you go into an equity research department. Everybody there is using 8.28% as a risk premium. Every equity research analyst said, that's your equity risk premium. The implied premium is 4.72%. The defense that the equity research head tells you is, we all use the same number. What's the big deal? If everybody in the department is using an 8% premium and the market implied premium is 4.7%, what's every valuation coming out of that equity research department? If they're doing valuations correctly, what will every analyst find? Every stock they look at is going to look overvalued. Why? Because they're putting an 8% premium and the market is demanding 4.7%. It's a recipe for disaster. I use the implied equity risk premiums in valuations, not because I think the market is correctly priced, but because I want to value GameStop given where the market is today. Because that's what you want me to do. I want to value Heineken given where the market is today. That's why I compute the implied premium at the start of every month, because I use that premium through the rest of the month. And March 1st, I'm going to change the number to whatever the implied premium is, because my job is to value companies and not to give you a market view with every single one of my valuations. So I want you to think about that. The implied premium is what the market price is. Think about what happens when you use a number very different from that number in your valuation and what it does to your value in your investment decisions. So that's about it. I will see you on Monday. Take care.
Thank you, Professor. You too,
Bye-bye.
take care. Bye-bye.
Thank you.